With inflation reaching its highest level in 40 years, a cost of living crisis, a war in Ukraine, and the stock market crashing, it's hard to imagine not seeing a recession this year. However, is this actually the case, or is the UK going to narrowly escape and get the economy back under control? Let's take a look and find out. Oh, but before we do, please remember to hit that subscribe button and tap that like button. It really helps with the YouTube algorithm. Before we dive into the details, let's first establish what a recession is. So a recession is defined as 2 consecutive quarters of negative GDP growth, or gross domestic product. And GDP is essentially the main measure of economic growth. It's based on the value of goods and services produced during a given time period. As an example, the UK's GDP in 2021 came in just under £2.2 trillion. This is approximately £152.3 billion more than the previous year, where GDP came in as just £2.04 trillion. In March of 2020, the UK was brought to a grinding halt due to COVID-19. For months on end, the UK endured lockdown after lockdown, with only a few select businesses still allowed and actually able to operate effectively. The complete economic standstill essentially led to the UK being thrust into a recession, with GDP dropping by 9.4%. Until May of this year, the UK has actually yet to experience any GDP growth, with zero GDP growth in February, negative growth rates of 0.1% for March and 0.3% in April. So now I have a bit of an understanding of where the UK's GDP is at. Let's now take a look at some of the other economic measures and leading indicators that can give us some insight into whether or not we will actually see a recession. It's vitally important just to note that there is no foolproof way to predict a recession. Economists have been trying for years and failing. But what we can do is look at common leading indicators and try and make an informed, educated guess and then act accordingly. Recessionary indicator number 1, the yield curve. I'm sure you've heard this term thrown about all over the place recently, but in this instance, we are referring to the rate of return offered by a fixed income asset, such as a bond or CD. And for those who don't know what a CD is, CD stands for Certificate of Deposit, and is essentially a savings account that holds a fixed amount of money for a fixed time period, such as 6 months, 1 year, 5 years, and so on. And in exchange, the issuing bank will pay interest on that. A lot of the time, when you hear people talking about the yield curve, they're referring to the yield of securities issued by the US Treasury. These could be investments that mature in a month, year, decade, and sometimes even longer. There are a lot of different yield curves, but it's important to note that all are based on the comparison of short-term and long-term interest rates. Economic theory says that long-term borrowing carries more risk than short-term borrowing. Therefore, the interest rates for long-term bonds must be higher than the rates for short-term bonds. Okay, so how does this actually relate to recessionary fears? Well, every now and again, in rare economic conditions, there will be times that cause investors to accept lower yields for longer-term bonds than for shorter-term bonds. When this happens, economists say the yield curve has inverted, and this is then thought to be a recessionary indicator. An inverted yield curve is thought to be the number 1 indicator of bad times, and for good reason. Historically, yield inversions have had a good track record of actually signaling bad times. Here's a chart illustrating this, with the white bars being recessions. Every year since the 1950s, yield curve inversions have typically preceded a recession. And currently, the yield curve has inverted to its biggest level since 2000. Recessionary indicator number 2, consumer confidence indexes. This measures the range of consumer attitudes towards things like forward expectations of general economic situations, household financial positions, and the views of making major household purchases. This index was down -41 in June of this year, 1 point lower than in May, where it sat at -40 of this year, and reaching a record low for 2 consecutive months. So it's fair to say consumers are not feeling overly positive at the moment. This comes as 13.7% of businesses believe their business performance will decrease over the next 12 months. And to make things even worse, a tourist on holiday in Italy fell into an active volcano trying to retrieve his phone so he could tell his friend to buy the dip on Bitcoin. Recessionary indicator 3. Unemployment. The latest labour force survey shows us that in the 3 months to April 2022, the UK unemployment rate sits at 3.8%. Or 1.3 million individuals considered able to work, currently unemployed. This is the first increase in the jobless rate since the last 3 months of 2020, with the number of those unemployed for up to 6 months rising to its highest level since late 2020. However, full-time employment reached an all-time high. Payroll employees were up by 90,000, a record of 29.6 million overall in May, and job vacancies in March to May of 2022 rose to a new record of 1.3 million. The rate of growth in vacancies, however, has continued to slow. So when we see rising unemployment, it is likely a sign that the country's economy is starting to struggle. And when the average unemployment rate is prolonged, this is then a sign that times ahead are indeed tough. Although this is a useful data source to consider, it's not always the best recessionary indicator or leading indicator, because it's often lagging and job losses tend to happen mid-recession than they do pre-recession. However, it's a data source that we 100% should definitely be keeping an eye on and make sure we keep up to date with the data, because it could actually alert you to the recession early enough in order for you to act. Recessionary indicator number 4, the stock market. This is one of the most commonly referenced indicators of economic health, and it's represented by a multitude of indexes. However, in this case, we will use the S&P 500 and the FTSE 100. Now, although the S&P is the most well-known, and a lot of companies in the FTSE 100 are actually actually have revenues that are derived from international sources, such as the US, FTSE 100 companies tend to be UK headquartered with international kind of reach, okay? So that's why I'm going to use both, because it's good to consider both in this scenario. The stock market often responds to future expectations. So basically this means that the individual share price can be considered a leading indicator of companies' health, and the overall indexes a leading indicator of economic health. Okay, so the two kind of go hand in hand. The S&P actually posted its worst first half since 1970. Since the start of 2022, the S&P is down more than 20%. The Dow Jones Industrial Average is more than 15%, and the tech-heavy NASDAQ is down almost 30%. And if we take a look a little bit closer at the FTSE 100, so far this year, it has produced zero growth. That's right, zero. And unfortunately, that has been the case for around 22 years. Now, the FTSE 250 has actually fallen more than 20% so far this year, compared to the FTSE 100, which has only fallen 6%. So in terms of indices falling, the FTSE has performed better. However, over the last 22 years, it's not performed very well. Now, although the stock market is a leading indicator, it can be very, very noisy and often curtailed by crowd mentality. And because it prices in expectations, it can be unjustly volatile, and not all expectations actually become reality. So it can be a bit skewed sometimes. So it's one of those data sources we need to consider along with everything else. Paul Anthony Samuelson, the first American to win the Nobel Prize in economics, once said famously, "The stock market has predicted 9 out of the last 5 recessions." So there we have it. The current state of the economy does not look that great. We've got a cost of living crisis threatening the health and well-being of everyday people, a war in Ukraine still threatening supply chains. It's no wonder the fears of recession are really starting to ramp up. But what do you think? Are we going to see a recession this year? Or are we going to be able to hold it off? We're going to have a soft landing? Let me know in the comments down below. And before you go, please remember to hit that subscribe button and tap the like button. I'll see you in the next one.